Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is January 22nd, 2026, and we're diving into Old Republic's fourth quarter and full year 2025 earnings report. Joining us is John, a senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Old Republic has just released their earnings, and there's a lot to unpack, from their net income performance to their strategic initiatives in the insurance sector.
Revenue and profitability overview. Let's start with the top line. Old Republic reported a net income of $206.3 million for the fourth quarter, a significant increase from $105 million last year. However, their net operating income saw a decline. John, can you explain this?
Absolutely. The net income increase is primarily due to realized investment gains, which offset the decline in net operating income, down to $184.7 million from $227 million last year. This decline in operating income is largely due to higher underwriting expenses and a less favorable combined ratio.
And what about their revenue streams?
Old Republic's net premiums and fees earned increased by 9.8% to $2 billion, driven by strong performance in their specialty and title insurance segments. Additionally, net investment income rose by 7.9% to $183.8 million, thanks to higher investment yields.
EPS performance and analyst expectations. Now let's talk about earnings per share. The adjusted EPS came in at 74 cents, which is below the forecast of 89 cents. John, what does this tell us?
This indicates a miss on analyst expectations, as the adjusted EPS declined by 17.8% from 90 cents last year. The shortfall is attributed to increased underwriting expenses and a higher combined ratio, which impacted profitability despite revenue growth.
How might this affect investor sentiment?
Missing EPS forecasts can lead to negative sentiment among investors, especially when the decline is significant. However, the overall growth in net income and revenue might mitigate some concerns.
Operational efficiencies and future outlook. John, let's delve into operational efficiencies. The combined ratio increased to 96% from 92.7% last year. What does this signify?
The higher combined ratio suggests increased underwriting expenses and loss adjustment costs. Despite this, Old Republic has maintained a strong book value per share, which rose by 22% to $24.21, indicating solid financial health.
And what about their capital management strategies?
Old Republic returned $742 million to shareholders through dividends and share repurchases, reflecting a robust capital return strategy. Their operating return on equity of 14.1% also highlights efficient capital utilization.